My name's Luke. I'm a private wealth manager for Melbourne Capital Group based in Malaysia. I've been based here for 7 years now, basically helping expats with various areas of financial planning. I'm here with Dan today, who is a director at API Global.
API are the best in the world in terms of UK property investments. We source, from a market research perspective, we source the best of the best from a pure investment-led perspective. It's about taking the emotion out of this, looking at the macro and microeconomic fundamentals on what to buy, how to buy, and then the structure along that from a leverage perspective, a tax perspective, and keeping it from into a hands-off, hassle-free investment.
So where are we seeing people sort of investing their cash at the moment, and where's the main areas of interest for property in the UK?
Yeah, and I think that there's lots of different methodologies and depending on sort of the strategy of the investor, but there's massive corporate relocation that's happened from sort of Brexit, COVID and things like that and huge growth zones in places like Manchester and Birmingham, where, you know, from a macroeconomic fundamental, if we just talked about Manchester, you know, if you look at the JLL Big Six report, you know, over the next 4 years, we're talking about a 19.3% growth from a macro level. And then what you want to do from there, because that's obviously the whole region, what we're doing is looking at the micro level and looking at the supply and demand imbalances and the key drivers that sort of support that, which is usually education, corporate relocation and transport, and trying to sort of zoom into those areas to find the growth zones within those growth zones.
One of the objectives we're having from a lot of clients is the fact that interest rates in the UK are pretty high at the moment, right? So expat mortgages currently sitting around what, 6.5%, 7%. How do you see that playing out over the next few years?
Yeah, so look, the strategy that I'm going with a lot of the time with different investors at the moment is, you know, let's offset the interest rates because they are coming down. They're actually, you know, we're getting around 5.9% at the moment to 5.5 depending on the investor profile. And even banks like HSBC are now doing non-UK mortgages for investors outside of the UK at pretty reasonable rates in comparison to where they have been, but still not ideal for where you'd want to be from a cash flow positive position. So what I would say one of the best strategies at the moment is lock in the off-time development with it, and then sort of you're not going to have to take a mortgage usually until another 2 years. And what we're seeing is where inflation rates are going and the interest rates, as soon as that comes down to about 4%, then everyone's going to start buying. So then all the prices are going to go up. So if you lock in the price now when sort of not as many people are buying, it's the best time to buy because you sort of win on the top and the bottom.
Yeah, okay, interesting. And another area that our clients speak to about, or we speak to a lot of clients about, is sort of legacy planning and passing assets on in the most efficient way as possible.
Yeah.
Are there any ways to make that sort of more efficient in the UK?
Yeah, and so look, what API do is we take the emotion out of any sort of sale, and so it's not about, you know, my mum lives in Bath, so let's buy a place in Bath or anything like that. It's taking the emotion completely out of it and looking at sort of the way to map an investment from a product perspective. You're aligned to the strategy of that investor, but then we're looking at the tax side of things, right? And then also the whole setup in terms of what the strategy of the investor is. And if you are talking about inheritance tax, one of the best ways to get around that is to put it in a limited company. So you're in a buy-to-let limited company. It's called a special purpose vehicle. And you can gift it similar ways to how you gift it to kids over a 7-year period. But obviously splitting shares and moving shares around is very easy in comparison to what you'd have to do from a gifting perspective of an actual just an asset. And also one of the best things about this from an inheritance tax planning is you can be in a situation where the kids, you can still take out the money out of it because you've actually invested the money into it. So say you've invested 100,000 into the property to buy it, and then you've used leverage for the rest of it. You can still take the yield out of that because you've got a loan note against it, even though the ownership is for the children. And so then you can sort of offside that. And then the other thing from an inheritance tax perspective, this is just generally in property. Say you had £1 million. If you put 100,000 into 10 different properties and then you took leverage on all the rest of it, saying you gifted this to the kids, and in 10 years' time that each of them had made 100,000, you're actually giving 2 million to the kids, and they'd only get taxed on 1 million if it wasn't in the SPVs. But if you'd gifted it and you put it in the right sort of SPV and limited company, then you're sort of giving them £2 million, which would be tax free, and you can still take the dividends out of the business.
Yeah, interesting. Okay, and what's the outlook for UK property at the moment?
Look, it's great. I mean, I think the key thing that you need to look at here is look at the last 200 years worth of data, right? I mean, literally try and find any sort of longitudinal graph that doesn't look like that. You know, people talk about, is it a good time to buy? The answer is yes, and it should, you know, yes, 5 years ago, if you'd have invested in these cities, what would your asset look like now? You'd have made money. See, people talk about, you know, when Donald Trump came into power and the sterling went low, oh no, they got worried about that, but carried on rising. COVID, Brexit. Now people are talking about, you know, Labour coming into government. You know, actually what we were talking about a minute ago and putting the limited company into a small business. They'd have to change the legislation across all small businesses for that to affect that. That's also another way to offset that risk. But realistically, what's happened even in the GFC, which is probably the worst ever, you know, it corrected itself within sort of 2 years. So yeah, the answer is yes today.
Yeah, okay, cool. And can you also talk us through briefly how people are using leverage to kind of maximize their returns from property?
Yeah, so look, in my opinion, the reason why property is such a great asset class is because you play with a leveraged asset. So, you know, if you say you put 25% in and you use the loan to value on that, say you put 100,000 into your 400,000 property, every percentage that goes up, you make 4. There's no other asset class that does that in this way. And if you're looking at the right sort of macroeconomic fundamentals and microeconomic fundamentals and product and where, you know, even when we talk about Manchester again, if you're talking about 20% over the next 4 years, if it does that and you're using that as a leveraged asset and you're putting 25% into that property, you know, you're making, you know, huge returns, which are unseen. I mean, if it does 10%, you're making 40%. And that's why it's such a great asset class.
Okay. Well, Dan, thanks very much. And yeah, if you're interested in diversifying your portfolio and looking at UK property as an investment class, then feel free to drop us a message. The details will be in the link below. Thank you.